Welcome to PocketExperts.Solutions. This event is for educational purposes. The terms and conditions and the privacy policy apply as posted on the PocketExperts.Solutions website. Today, our guest expert is Darrell. Welcome, Darrell.
Thank you, Mark. Delighted to be here.
Darrell's forensic accounting, litigation, and business valuation related experience includes both expert witness and consultation before various courts and juries in a wide variety of complex matters. His expertise encompasses an extensive scope of cases including construction, financial services, healthcare, insurance, leasing, manufacturing, real estate, retail, transportation, and utilities. His education and certification: he has a BS in accounting from Arkansas State University, a CPA, an MBA, an ASA, a CVA, ABV, CMA, CMC, a DABFA, a CEA, and a CFF. All of those interpretations of those credentials can be found on his profile in the PocketExperts.Solutions profile. Today, we're going to talk about forensic analysis of financial statements. As we open up this meeting, any opening comments?
Yes, I have one, Mark. First of all, thank you for this opportunity, but most importantly, thank you to you for the enormous amount of blood, sweat, and tears that you put into this process. I know you've done an extraordinary amount of work, and what you've assembled is unprecedented.
Well, thank you. We hope it'll benefit all of our members and give a lot of growth and expansion of business throughout the country. Let's take a look now at the very first question. What is the purpose of forensic financial analysis?
It's a great question, and we refer to that as FFA, Foxtrot Alpha, Forensic Financial Analysis. It's an essential and literally never-ending responsibility of the forensic operator, and that's us, meaning we're forensic operators. We happen to be accountants. We're forensic accountants, but more importantly, we're forensic operators. We go way beyond mere numbers, and we look at behavior. We look at words. We look at things like barometric pressure impacts on a potential litigant, and so on and so forth. So the forensic financial analysis focuses on the forensic operator. That's foundational to opinions that will typically be involved in civil, criminal, and counterterrorism aspects. Now, in doing that, forensic operators come from a wide range of disciplines. Typically, when you hear the word financial forensic, you'll think it's an accounting type, but just having an accounting background is completely inadequate to really have the forensic capabilities. With that foundation of, say, as a forensic operator, you're able to objectively analyze processes considering all feasible data, all feasible techniques, and most importantly, the parties that are involved in the respective matter, whether that's buying or selling a company, or whether that's, say, analyzing a crime scene. So the process has to be thorough. It's got to avoid arbitrary appearances, and going through that should lead any other parties to the same conclusion, even if they don't like the conclusion. They can't argue then about the process or the data or the veracity and so on and so forth. So forensic financial analysis is used for almost any aspect of involving financial decision making or financial disputes.
Well, it's important too to identify the difference between a financial analysis and a forensic financial analysis, right? Different focus?
Yeah, well said. Well said.
Yeah, we need to make sure that when you're looking for hiring somebody for a particular job, that you know the distinction as our member to be able to understand the difference between a forensic financial analyst and a financial analyst.
Yes, yes, and I have a couple of what I call acid tests about that. If there's a, let's say someone who claims to have forensic capability, and I've used this in court many times, and I even the attorneys we work with, I tell them to use it, and they typically apply it in cross-examination. But question one is, sir or madam, you claim to be a forensic accountant or forensic analyst, as the case may be. Define for me, if you would, forensic accountant. Now, I, having sat through many depositions and testimonies and so forth from accountants claiming to have the capability, it's almost comical to see them stumble because they don't have a definition. In fact, there's not a generally accepted definition. Uh, the accounting profession has provided 5 different versions of what they call the definition, and it's utterly inadequate. So, uh, step one, ask the person to define why he or she thinks he's a forensic capable accountant or just operator. Second question is, after they stumble through that, ask them what methodologies of investigation, of analysis have they been trained in? And again, they will stumble. They'll have no ideas. And I can tell you, having been trained by the FBI and BATF and attended CIA training and SEC and so on and so forth, that most federal agencies follow a 4-step process for analysis. The IRS has 5 major criteria that they use in their investigation of tax returns and related filings. But that second question, tell me what methodology you apply, again, will leave the person simply flummoxed, for lack of a better term, because there is not a generally accepted methodology definition, although there are several generally accepted methodologies, particularly in the financial criminal world.
So somebody that
So
actually is a forensic financial analysis person would know that there is no such definitions, right?
exactly, yeah, precisely right, Mark. Yeah, and they'd
So
be able to describe it. They'd be able to cite it, reference the terms, and uh, that what that does is establish his capability. Because otherwise, if you don't have a methodology, it's a slapdash process. It's the same way the military is trained. Let's say 82nd Airborne Division, for example. They're highly skilled, very well trained in the same methodology. The 82nd Airborne does, their expertise, their central core is to secure non-domestic airports. So they'll fly to Nicaragua and uh, secure a non-domestic airport. That's a theoretical process, but they're experts at that. Now, same thing with a forensic operator. He or she is an expert in the process. And if they're not, all they're able to do is have training in accounting, and they're fine with financial statements. But the investigative process is a very, very different animal, particularly when it has to lead to some kind of a conclusion, whether that's civil or criminal.
right, exactly. What's the history of the FFA?
Well, the genre dates back to the late 1800s from the written standpoint, and has been codified kind of what I'll call parallel processes over the years, and has arrived at different types and methods and methodologies. As I mentioned before, the certain parts of federal law enforcement have a 4-step process. Some of the other aspects of investigative methods, there's a methodology called FAME, Forensic Accounting Investigation Methodology, and it has a multi-step process. It has 4 phases, 13 stages, and 50 some odd codified aspects to it. Now, when those methods are applied, it's just like in the military or law enforcement or firefighting or emergency room physicians. they're trained in a certain procedure, but invariably circumstances are different. And so they have to adapt and anticipate and respond to the circumstances. So as the military says, no battle plan survives first encounter with the enemy, but they still go in with a plan and they still are able to adapt to it because they're so well trained that they know how to do that. Now, it's the same aspect for forensic financial analysis. When we train people in that process, they are so highly skilled, saying, here's a set of records, here's the assessment, here's the people they interview, so on and so forth. They're so skilled that they're able to enter a set of circumstances regardless of what's happening and adapt, anticipate, and then achieve with respect to what has to be accomplished under those circumstances. So training is absolutely essential. It has to be way, and I mean way beyond mere accounting, has to include people understanding and capability. And with that training, constant training, goes the adaptation process based upon the circumstances and the objective of the assignment.
How does it work?
Well, it works two ways. First of all, it works in presenting your conclusions, and it works in defending your conclusions. Because let's say in a criminal matter, you're doing analysis and you've decided that the CEO has defrauded the company by virtue of manipulating stock prices. So you have to go through that analysis, the interviews, the interrogation, so on and so forth, and arrive at an opinion. Invariably in cross-examination, you're going to be challenged in that process. So first of all, you would be able to say you've been trained in multiple methods that forensic operators apply, methods regarding data, methods regarding analytical procedures, and diligence in things like identifying, collecting, validating, organizing, and examining the data before you ever head down the path to arriving at a conclusion. Now, what that does is it fills the vacuum in the financial forensics discipline because accountants are generally well trained, law enforcement generally well trained, but there's a vacuum regarding the nature of training and education when it comes to forensic operators. Now, let's take one example in the financial realm. So let's say someone goes to school, gets a Bachelor of Science degree in accounting, and what they've done is taken, junior or senior level courses, university accounting, and perhaps finance classes or both. And they've learned basic, and I mean basic techniques like simple ratio estimation, perhaps horizontal and vertical analysis, trending, compound rates, so on and so forth. Those are the basics. And when I say those, immediately you understand those, Mark, and someone else who's had an accounting background would understand them. Then next, they typically be exposed to analytical techniques as they go to work for their various employers. And that could be, say, public accounting, that could be law enforcement, that could be, say, public companies or private companies who have large enough to have accounting staffs. Now, if they couldn't offer anything to the new trainee beyond, say, undergraduate or graduate training, the forensic operator seldom advances beyond that level unless they take it on their own initiative to do so. And if they do that, then they'll learn analytical techniques through additional training, through continuing professional education, other offerings. However, most of those course offerings typically it merely just reinforce the basics they've already been exposed to. And so consequently, there just aren't that many additional techniques that are provided that are more robust or capable of applying forensic tools and techniques.
Okay, good. Can the FFA be used for other purposes?
Yeah, you raise a great point there, great question. The forensic financial analysis has strengths and weaknesses that inevitably result from an educational process. with the weaknesses sometimes outweighing the strengths. Now, the strengths include knowing how to calculate a few basic techniques and maybe interpret the results. What comes to mind would be something like, what's the significance of compound annual growth rate? Another weaknesses could include things like absence of a formalized forensic methodology, not an accounting methodology, but a forensic methodology and the requisite techniques to interpret the implications of the results. Also, it could be a lack of awareness regarding even the existence of forensic tools and techniques. I do a lot of training around the country. Accountants, attorneys, law enforcement, regulators, business owners, you name it. And often when I show these techniques, like say the Tata method or CQI or some of the others, it's almost jaw-dropping to the attendees because they've never had the exposure to it. They didn't know they even existed. And that has to do with our educational system. And I actually was a speaker for a session today with one of the large accounting associations, and was very critical about the process. And they need to train it and provide those techniques at the primary levels. Additionally, the typical accountant without forensic knowledge would not even know when or whether or how to apply the forensic techniques. Is this a good time? Is this a bad time? What data do I need, etc.? And so there's incomplete knowledge with respect to them, and they don't have the ability to interpret it and then apply the techniques that are essential and requisite in even basic financial analysis. So consequently, they end up inconsistently considering the importance or an application of one technique versus another. And what that leads to, you're probably already thinking about this, that a few basic simple techniques then become what the party relies upon. And that's where the growth stops. So the absence of an objective like learning means then to evaluate and score the results so that the party then becomes more and more and more skilled in the analytical process and a more capable forensic operator for the benefit of the client or the company for whom he's working.
Okay, good. Let's take a look at our fifth question here. Why does it work?
It's really important. Fundamentally, forensic financial analysis is only a form of data analysis. That's all it is. And I don't think anybody would disagree with that. Therefore, someone who understands the analysis can execute such analysis, forensic financial analysis, and vice versa. However, the minute I said data analysis, that's often a starting point. And it's important to understand that merely being given data and starting to work on that data is a mistake. First, you have to determine the veracity, the reliability of the data. And classic example is financial statements. People who do valuation classically take the financial statements and then move forward on valuation with scant or no true forensic analysis on the content of the data. They may do some normalizations and so forth, but with regard to veracity and repeatability and reliability, there's an utter absence of that. So when we oppose people in valuation assignments, we routinely are able to embarrass them, for lack of a better term, because they simply do not have the skill to do the forensic analysis before they ever get to the valuation analysis. But regardless, the processes parallel one another. The data analysis, as once the veracity is established, as it flows into the forensic analysis.
Okay. How is it implemented in complex financial statements?
Well, there's a very simple methodology, and there are 5 elements to it. So let's say that someone is given a spreadsheet of data, or let's say someone is given uh, company expenditures on a monthly basis for 36 months. So you're only looking at, let's say, operating expenditures for 36 months. And now you're going to analyze them for purposes of, let's say, merger and acquisition analysis. So the person doing the analysis to apply forensic analysis needs to understand there are only 5 types of knowledge regarding the content of that data set that you're dealing with. And those types of knowledge are the composition, the boundaries, the central tendencies, the dispersion, and the dynamics. Now, let me describe that in a little bit more detail. I gave you 5 descriptors there. Composition was the first one, and composition has to do with the entire data set. In this case, I said monthly data for 3 years of operating expenses. Then the boundaries, I've already said, for 3 years and by month, from whether they're organized by alpha or by size or just at random. The central tendencies then become those measures that are identified, so you can now start to see how the data behaves. This dispersion tells you how wide the central tendencies are flaring, and then the dynamics have to do with the period-to-period changes within and among the various data elements.
Okay. What are the principal benefits of implementing the FFA?
Well, I'll tie those back to the 5 categories: composition, boundaries, central tendencies, dispersion, and dynamics. Anytime you look at any data set of any sort, those are the 5 criteria you need to introspectively review. Composition says, here are the items that comprise the data set. And I mentioned that it's, operating expenses by month for 3 years. That's the composition of the data. Now we can analyze that. We can measure things like averages and so on and so forth. Boundaries of the data then helps you understand the relative size, both within and among the items. The central tendencies help you to start to observe data clustering, which could occur within and among the data. Dispersion starts to identify the variance from the central tendencies, and the dynamics indicate change rates in the data. Now, those then result in their respective determinants from implementing things like forensic financial analysis. And to do that, the analysis requires 5 types of knowledge regarding the contents of a data set. The visuals are essential to any form of data analysis. I can't tell you how many times I've seen in trials and in dealing with accountants and financial types that they may be wedded to their data and have great pride in their massive spreadsheets, and the data is, the numbers are truly impressive, but they fail to include visuals. Visuals are essential for any type of data. And visuals will indicate the shape of the data, the span, whether it's clustering, the movement, and other indicators. So visuals are essential. In fact, there's a famous, a well-known technique for financial analysis where analysts refer to something called Anscombe's quartet. And Anscombe's quartet comes from a gentleman named Francis Anscombe. That's Anscombe. And he codified the quartet. And if you saw the visual, I have in front of me, wish you could see it, I have a visual of 4 different XY coordinates with the same data. Now, the mean of the data, the variance of the data of both the X and the Y coordinates are identical. The correlation between X and Y in each case is identical, and the linear regression line in each case is identical. However, if you saw the visual, and this is what Anscombe was pointing out, that despite having those identical quantified characteristics like mean and variance and linear regression and so forth, the visual representation of the data is vastly different. And so he has numbers, a data set with exactly the same statistics, but vastly different visual indicators. So that just indicates that anyone doing forensic financial analysis has to include the visual to reflect the data and not merely the statistics indicating the patterns and the movement of the data. You simply will not be able to understand the data unless visual representation is added to the composition, the boundaries, the central tendencies, the dispersion, and the dynamics of the data.
What are the principal determinants from implementing FFA?
Okay, yeah, that's where we're talking about the aspects of the data description, the indicators, the determinants that measure. What you're doing is saying, here's the activity of the line data that I have. So if I have 3 years of monthly operating expenses, I'm looking for within that data set, large number of numbers there. How do I possibly approach that? How do I have to take each individual data set or each individual line item and calculate the mean, the median, the mode, and the standard deviation and so forth? Or how can I effectively and quickly determine the quality of the data, the veracity? Because remember, most accountants just take the data as is and go from there towards, say, valuation or analysis, but you have to determine the quality of the data below that. So your simple means to do that is prepare an XY coordinate, lay it out on 36 months by some, as I mentioned before, it could be alpha, it could be size, it doesn't matter, and then measure those aberrations. Now, what you will see in things like, let's say, the depreciation category, it's going to be relatively stable for most parts, assuming that the company enters depreciation on a monthly basis. Also, you may see things like utilities being relatively stable, unless, of course, it's operating heavy equipment with a great deal of electricity, which is then probably going to be showing up in cost of goods sold as a cost. Then with those other measures, what you're doing is determining those that jump out as outliers or aberrations from occurrence. Now, once that happens, as I say, you're seeing the ones that are fairly common, fairly consistent. You would focus first of all on the outliers that tells you for some reason those costs are behaving differently or those expenses are behaving differently than what you would expect. And that could be a determinant against the revenue patterns. Some, some expense items, will vary accordingly to revenue changes. Some won't. Some will be fixed. Some will be variable. Some will be semi-variable, so on and so forth. But by arraying them, you're then starting to be able to approach it in a structured manner to identify those aberrations and looking for the larger items first and drilling down from starting on a monthly basis down into individual transactions, conducting the same analysis to find those aberrations. Now, once you go through that, you're starting to find those items that fall out for further validation, we'll call it. And what's the validation? What you're attempting to do is determine that those numbers actually belong there. Those amounts are accurate or representative and appropriate, and so on and so forth. And by doing that, what you're doing is satisfying yourself that the aggregate of the results that you're looking at is indeed reflective of the summarized data that you're looking at.
Okay, and that kind of leads us into the next question, right? What does FFA seek to identify?
Yeah, that's a really good question because in its most basic sense, what you're trying to identify is aberrations or variability in the data. Now, aberrations are important because everything else being equal, the data created and resulting from business operations, and keep this in mind, should behave in a predictable manner. Now, this all goes back to the basics, not just debits and credits, but even more deeply, the chart of accounts. So if I look at a chart of accounts that says, here's raw material, I have to have a degree of confidence that says the way we've identified this raw material, and let's say we have iron ore, that we know that anything we pay for iron ore, whether that's uh, large amount, small amount, is properly categorized. And once it's properly categorized, then it's properly aggregated. And when it's properly aggregated, then it's properly measured and trended. And so in this most basic sense, or a forensic data sense, what you're looking for is aberrations or variability. Now, when you see that, you then seek to determine what caused that aberration. And if it's explainable, what that will help you do is establish a pattern and an application for example, developing the valuation of a company or determining that there are mistakes in the numbers. And when I said we've talked about 36 months of operating expenses for a particular company, you're probably looking at thousands of transactions over that time period. And so you have to expect that there are A, some errors in there, B, perhaps some recurring things that need attention, or C, perhaps misleading data, constructed data, data that shouldn't be there, too much or too little. But by doing that drill down, that decomposition, and identifying those trends, aberrations, patterns, determining whether or not they're applicable or otherwise, will give you a keen insight so that now you've got a set that you can either clean, mean correct, make corrections in, or can then apply for in a valuation sense, in normalization, or say in an acquisition transaction, you realize that, gee, of the $46,000 in contributions, $27,000 of it was to a softball team, and the new buyer is not going to use or continue that type of contribution, and so consequently that would have an adjustment necessary for the valuation of the company.
Right. So a lot of the times this would be really useful when you're actually looking at acquiring a particular entity and going through the numbers to see if the underlying value is in fact intact based on the fundamental information that was given, right? So
That's exactly right.
if there was an issue, I mean, when we do valuation work, you're right, we kind of accept and we ask questions for reasonableness, but we do not do the forensic financial analysis. And I think that the member needs to understand that and the difference between the valuation process and the financial forensics analysis process are two completely different things. And one actually digs a lot deeper than the other.
Yes, well said. Well said.
What is the MUA, multiple or multi-attribute utility analysis?
Yeah, that's sort of the heart of forensic financial analysis, MUA, multi-attribute utility analysis. Now, it's comprised of elements that lead to a conclusion. So let's say we're looking at buying a company. And let's say we're given financial statements, and let's say those are audited financials supplemented by operating reports and supplemented by general ledger access. So we have the entire panoply of data available to us. So the question becomes, how good is this data? It's been prepared by a CFO and a staff, and it's been audited, and then the IRS has looked at the tax return. And my answer to that is, so what? That's interesting, and I'm glad to know that, but I want to drill down more deeply. So with that forensic financial analysis, we categorize those into two components: data description and data analysis. Now, the data description has two subcategories to it: data composition and data boundaries, and I referred to those earlier. But go down even more deeply. Data composition has measurement elements like frequency distributions and common sizing measurements. And so the data composition itself needs to be evaluated and determined through the examples I mentioned for analysis. The data boundaries then, which is the second component of data composition, includes things like minimums, maximums, ranges, other indicators of boundaries, because with composition, you're given 36 months of financial statement operating expenses. Yet that's the composition of the data. Now you're starting to understand it. The data boundaries include things not just the time period, but the boundaries of minimum amounts, maximum amounts, range amounts, etc. And in aggregate, that composition and that boundary component yields data description. Now, once you've described the data, now you're starting to understand the data. Now you have to start analyzing the data. And data analysis has three subcategories to it: central tendencies, dispersion, and dynamics. Now, the first component of data analysis is central tendencies, as I mentioned. And the obvious examples there are things like mid-range, median, mean, quartiles, and other measures of centralization, so you can start to get a handle on the data. Once you've completed those categories, and I'm only giving selected examples here, then you move to data dispersion. And the dispersion is conducted by tests like variance analysis, IQR, which is interquartile range, MAD or MAD, which is mean absolute deviation, standard deviation, coefficient of variation, and Z statistics, among others. So now we've got not only the data composition, the data boundaries, and central tendencies, now we have the dispersion. And we're almost there understanding the data. And finally, here come the dynamics of the data. And the dynamics reflect the movement within and among and across and between those 36 months of information we're talking about. And that comprises things like raw changes, percent changes, common size changes, moving average, progressive average, weighted averages, CAGRs or compound annual growth rates, geometric means, and so on and so forth. And again, I'm only giving selected examples here, but those 5 subcategories that we talked about and the 3 we just mentioned, central tendencies, dispersion, and dynamics, flow into data analysis. So as I started with, to achieve forensic financial analysis, you have to achieve 2 things: complete a data description and complete a data analysis. Data description requires data composition and data boundaries. Data analysis requires central tendencies, dispersion, and dynamics. And then again, we could drill down another level, at least one other level, using the methods I talked about, such as IQR, MAD, variance analysis, and so forth. In aggregate, then, we'll take those conclusions and we'll apply multi-attribute utility analysis. And if we had, let's say, 6 categories of information, we could then measure which of those categories fall in a relatively reliable range, or those anomalies that fall outside that range. And that will then tell us which areas merit further drill down and further inquiry and further analysis in order to derive, to satisfy ourselves that the data is indeed representative. Now, there are times, I will tell you, that in doing this type of analysis, that there are conclusions that arrive at pretty similar answers. So let's say we've got 37 categories we're looking at, and we do the multi-attribute analysis based upon the 5 segments we've discussed, and perhaps 2 or 3 of them tend to come out with the same score. Then the answer is pretty simple. Just focus, again, do the same exercise, focus on those 2 or 3 that are demonstrating those anomalies, and drill down again, and you'll then decide that one of those merits the respective drill down. You complete that, assuming there are no problems, you go to the next one, etc. So that's the schema. That's the means by which you go through that process.
Okay, great. As we go through that process, do you have any closing comments?
Yeah, I would say that never take anything at face value. When you're given a set of financial data, and I don't care if it's audited by the world's best accounting firm or your absolute single most trusted accountant, still you have to look at it with a very skeptical eye. Don't make the mistake of just starting with that data and moving forward, say with acquisition analysis or other analysis. Conduct your own drill down or instruct someone to do so with the same methodology, and do selective analysis, selective application using some of the methods I've summarized here, and then you'll have a degree of alliance upon which you can base to move forward with further analysis as necessary.
Okay, great. I want to give you a great thank you for your time and energy and all of the information you've given us tonight. If you enjoyed today's events, feel free to explore other opportunities as presented by Darrell and other members of our team on the PocketExperts.Solutions website. Thank you for spending time with us and enjoy your journey to achieving your goals.